Hello everyone and welcome to another edition of ChartYourTrade.com's free webinar series. I am your host, Michael Ahmad. I am the founder of ChartYourTrade.com, and today we'll be discussing Advanced Entry and Exit Points Part 1. With us again is keynote speaker Adam Sarhan. Adam is the founder and CEO of Sarhan Capital, which is parent to FindLeadingStocks.com. Without further ado, here's Adam.
So I've developed an investment system titled DAMP. D stands for defense first, A is advanced entry and exit points, which we're going to discuss tonight, M is market conditions, and P is psychology. I'm a big fan of psychology, not just in markets, but in life in general. And everything that we do in markets translates into life in some way, shape, or form, because at the end of the day, from my belief, is that the markets are an illustration of human psyche or psychology every single day, and it's all the participants. Even the computer traders are programmed based on human entry points. The computers don't program themselves. So that being said, what is the A component of DAMP? Well, the idea, the basic concept is that you want to increase your returns by lowering your risk. So if you start thinking in terms of risk, it's going to help frame the whole conversation and allow you to understand the concept much better. Any entry point, long or short, it's going to be agnostic here for the purposes of this conversation, that provides you a clear lower risk exit is an advanced buy or sell signal. So that's a very, very broad term of how I define advanced entry and exit signals. Now, there's a million different ways to do this. This is how I do it and how I've been successful doing it. So when you get in, you can't just pick a number out of the hat and just say, you know what, the S&P right now is at 1848. I'm going to go out there and say I'm going to get in at 38 and I'm going to get out at 28. You know, that's just, you're just throwing shooting from the hip, for lack of a better word. The idea is when you pick those entries is that you want to pick them based on prior chart action and see what really is moving the market and what areas that support and resistance have come into play in the past, so you can understand how they're going to go forward. Like we spoke about the S&P, where it pulled back on Monday right to the highs from last month, which isn't a coincidence because we see that happen time and time again. So there's two types of exits. A lot of questions even tonight we've had emailed earlier have been, when do I get out? You know, the entry point, okay, we can get in early, which we'll talk about, but when do I get out? So there's two types of exits. One, when you're taking a gain, and then two, when you take a loss. And we'll discuss both of those by the end of the evening. So in order to understand the advanced entry points, it's really important to understand how markets move. One of the best books out there is Stan Weinstein's book about profiting in bull and bear markets. And he simplifies the whole concept of stocks and any market you're trading to 4 set stages. It's a little different than the other stages as far as base stages. This is just broader stages of any move in any stock or market or anything. You have stage 1, which is the left side here with a gray area, and that's a basing stage typically. And then you have stage 2, and that's the uptrend. Stage 3 is the top, and then stage 4 is the downtrend. And this cycle just happens over and over and over and over again, a million times in almost everything that's publicly traded. The premise is that everything moves in 4 steps. Now, within stage 2 and stage 4, there's multiple stages. There's multiple bases, there's multiple stages, however you want to word it. I don't want to get confused by calling stage and stage. So we'll say there's multiple steps along the way during stage 2 and during stage 4. But as long as you understand that the broader context, where you are in that move. You know, right now in the market, we're clearly in stage 2. That's where we're at. So the question becomes, are we entering stage 3, or how late in the game are we in stage 2? If you look at the stage 2, are we right here? Are we here? Are we here? Or are we up here? But we're clearly in stage 2. So understanding the stage analysis is critical to understanding when to get in, when to get out, because each individual stock does the same exact thing. The earlier in stage 2, the ideal entry point is, you know, once that breakout happens, or the earlier in stage 2, the better the chances are that move's going to continue and you're going to capture a strong trend. Now, also the earlier in stage 4 on the way down, the same exact thing is true. So the idea is, how do you define it? Well, unfortunately, there's no crystal clear 1 + 1 = 2 way of defining it. It's more of interpreting what you see happening in the now. And that's very helpful, because I don't know what's going to happen a year and a half, 2 years, 5 years, 10 years down the road. Neither does anybody else. And if anybody tells you they do, they're just making it up. But what I do know exactly, and there's no question in my mind, what is happening right now. And that behavior that goes to that psychology component is critical. Now, part of understanding the time frame and the exits and entries and advanced signals and this, that, and the other thing, it's extremely important for you to define your time frame, because that defines you. Are you a trader? Are you an investor? Are you a swing trader? I mean, there's infinite ways, more or less, that you can define yourself. But really, what is your comfort zone? And you can be both. You can be neither. You can be all. You can be any combination thereof. Short term, medium term, long term, anything in between. And how you define short, intermediate, and long is up to you. Typically, for this, as far as taxes are concerned, anything over a year is considered long term, and anything less than that is intermediate or short. But as far as day trading, this, that, and intermediate, days or weeks or months, swing trading, one of the guys we had a conversation with recently had a whole thing about swing trading and how do you define it. Time, it's all an art. It's not a science as far as you personally define the time frame that you're comfortable in. I know guys that are very, very successful in all three time frames. I know traders that are extremely successful, and I know investors that are exceptionally successful. We all know Warren Buffett, exceptionally successful investor, and his whole outlook is he's not buying the stock, he's buying the business. And he doesn't care what happens in the stock as long as he's buying value in that business. He wants to own the business. He's doing that through the stock, but that's secondary. The primary thing for him is the business. Different mindset altogether. The purpose of the advanced signals is more for a trader than for an investor. And however you define your trading, it could be a few weeks, a few days, a few minutes, a few months, it's up to you, but it's important for you to define what you're comfortable with, because what I'm comfortable with definitely is different than what you're comfortable with, and what you're comfortable with might be difficult what the next guy's comfortable with. So if I tell you, hey, Joe, this is exactly how you have to do this, but you're not comfortable doing it that way, it doesn't matter how good I am at doing it, you're not going to get the same result, and you're going to be frustrated because you need to find something that's comfortable for yourself. So what exactly are we looking at with the advanced signals? Now, you're looking at support and resistance, extremely important. You're looking at chart patterns, very, very important, which we'll go over. Trendline breakouts. There's a classic breakouts, anticipating the breakouts, that's more advanced, moving averages, and then pullbacks off the high, which can be combined with the trend lines. Today we're going to cover three main areas. Hopefully, if time allows, we can go to more, but the three main ones are support and resistance, trendline breaks, and chart patterns. What is support? It's not an exact number. It's a zone. It's an area. Now, people say, well, undercut this by X dollars or cents or pennies or percent or whatever number you want. And that's fine. It happens. I mean, look at this right arrow. It undercut it briefly and then shot right back up. So it's important for you to understand it's a zone. And what is support? It's a psychologically important area, or an anchoring, if you want to use the exact term, where other traders and investors, where the market bulls have stepped up and defended the stock or the market at that level multiple times. The more times, the better. And if you notice, resistance is the exact opposite. Resistance is, again, it's a level, it's a zone, an area. It's not an exact number to the penny. And I know many, many people are frustrated because they want to be told exactly that penny. Well, give me exact rules. Unfortunately, the market, I found the most success has been when you're able to take it as more of an art than a science. That's what works best for me. There's other people that do the exact opposite and are very successful. So I recommend you doing what's best for you. But from my standpoint, understanding the concepts and then how you apply the concept is critical to success. Because if you don't understand the concept, no matter what the rules are, you're not going to be successful in this business. The resistance, every time it gets up to this area, in this case it's 50-50, it falls. Gets up, falls. Happens, this time it's a deeper fall, gets up again, and then falls. So what happens is you have a situation where eventually it either breaks out or it continues this range-bound action, and then it bounces off of support. Now, how do institutions think? Because a lot of the individuals, even smaller guys that are institutions or RIAs or that manage money, small hedge funds, they don't have access to the research from the big banks. They're not sure exactly how successful institutions think. So it's extremely important from my standpoint to understand how they think, and then I can take those concepts and apply them, and so can you. Number one, they think in advanced strategies. Everything that's so common out there on the internet, most likely, some of them could be doing it, but really there's more of a nuance to it, or there's some type of an advanced strategy there. They think in terms of probabilities, and they respect, and they always want to lower their risk. So how do you think like an institution when you're an individual or even a small guy trading? Okay, so you see resistance, and it happens all the time. Any one of the boxes we spoke about earlier, or we'll get to again in future examples, what do? Well, you can just wait and buy a breakout above that, and that's more or less what most people do, and that's perfectly fine. And then you say, okay, I'm going to get out if it breaks down, negates the breakout. If this is, that to me is incomplete. It doesn't tell you the whole story. Are you in stage 1, stage 2, 3, or 4? And then how many times has resistance been tested? But what they tend to do in big successful institutions is that they show up and they defend support and resistance. So more or less, they're buying support and they're selling resistance. And they do that multiple times. And then when the breakout happens up or down, typically that means a shift has occurred. But if you're able to say, okay, I'm in a stage 2 uptrend, which we're in now in the market, I'm looking at these leading stocks. Most of the ones that you're looking at should be in clear stage 2s now. What am I going to do? Am I going to buy the breakout above resistance? You could, but typically that's a classic entry point, and that doesn't give you an edge. The edge is stepping up and buying support. Not only does it lower your risk, but it gives you a clearer area for you to exit, and you can take a larger position because you have a smaller or a closer exit. So there's a few advantages to stepping up and acting like an institution, buying support and buying, or selling into resistance. Now, let's take, how's this example of this in real life? Let's take a look at this. Well, here's a chart of Apple from a few months ago when it was the prior chart highs. Here were resistance, and then they became support. And as you saw this multiple times, it bounced. We put the stock out in the Find Leading Stocks service, and bought it right here in that day, and then just shot up. We sold it somewhere in that area, and then buying it back. But more or less, what was the idea, the rationale behind this entry point right here? Most people are buying this breakout up here, but that's too far. Also, we're getting in here because we're now acting as an institution. Not by institution, I'm implying that it's a successful institution, not just any institution. So what does a successful person do when they look at this chart and they say, okay, you know what? This area was resistance. It's now become support 1, 2, 3 times. Now, this time it could have tested it 4 or 5 times, which is fine because we'd still be in it. It might have taken longer before it to shoot up, but still we'd be in it. And the whole idea is for you to lower your risk. So instead of getting in up here and then having that breakout ultimately negated, because it did, if you would have bought up here, you'd be frustrated because you're now out and your profits are gone. You get in here, you're able to get out, even if you wait for the 50-day to break, whatever it is, that's fine. But you're still profitable because you're getting in earlier. And that concept is extremely important for everyone to understand. Here's a classic entry point that we just discussed if you want to see it illustrated. So here's the early entry point, here's a classic entry point. You're buying it above that high, 10 cents above it, $1 above it, the max 5%, whatever it is, it doesn't really matter. That's all secondary. Again, the whole concept of a classic breakout is that you're buying it after it breaks out to a new high. The problem with that, again, is that look how extended you are from the 50, and more importantly, look at how extended you are from support. So it's a little bit different from traditional teachings as far as getting in. Well, you buy the breakout, sure. I would offer a different way of looking at things, saying, okay, well, what I do is say I want to get in here, and if I'm going to do a secondary or third buy, you make a case you can buy it on the right here on the way up, anywhere along those lines, if you're so inclined. If not, you buy the position here and you're out if it breaks here. And most of the time, if support's going to hold, it doesn't break. And if it does, you're out, and you can always get back in. Again, if that happens, you're risking a very, very small amount. So classic entry signals. We saw that breaks out above resistance, breaks down below support if you're going to short in a stage 4. The problem is that most breakouts fail. I can't tell you how many people come to me and say, hey, Adam, I bought this breakout. It failed. Frustrated because they bought it up here and then the breakout failed. I mean, they didn't make any money. Stock was profitable a little bit or it just failed right away. Either case, they didn't make any money and they actually lost money, and then it happens again and again and again. So the problem with buying classic entry points, I found in my studies of the strongest stocks and of my own performance and studying my mistakes that I've made early on and keep making, but learn from them and avoid making the same mistakes. But you keep studying and getting better and better because it's a never-ending evolution to improve. And I'm the biggest critic. I always critique myself to see how I can improve. And what I noticed was that the classic entry points just weren't working for me. So I had to go back to the drawing board and just say what works. And I noticed after studying hundreds and thousands of charts and just saying, okay, if you buy when the institutions are buying, you have a much better chance of really sinking your teeth into a strong stock because you won't be shaken out. Advanced signals. So if you act more like an institution. One of our long-standing clients has been with us for over 10 years. He says, Adam, I ask myself is what will Sarhan do? And if you ask yourself before you get in, is this something that Sarhan would buy or Adam would buy, that or an institution, a successful person would buy, it'll help you out a lot because it'll filter out the weaker ideas. And think of yourself as if you're a portfolio manager working for me and you had to come defend that buy. Would you buy it? And that's a litmus test that's very, very, very important. And if you had actual accountability to other people, you'd really think twice about buying or selling as not frivolously, but that's not the right word exactly, but as loosely as you do now when there's no real accountability outside of yourself. And the big problem most people have is that there is no accountability. You're the one buying, you're the one selling, you're the one looking at the statements, and if you don't do well, you don't do well, and you keep doing it and just repeating over and over and hoping things are going to change. So the accountability factor, just from in your mind, it's important. That first step for the advanced signals, ask yourself, what would an institution do or a successful person do? And if they're not doing that, don't do it. Now, the trend line breaks within a base is a second important advanced signal, which we'll get to in a second, which allows you to get in again a little bit early before the entry point. And the idea is that it offers a safer, higher probability entry and subsequent exit. Now, a big frame in mind is when you get in. Let's say you get into Apple. When do you get out? So what are the exits? Well, there's two types of exits, which we'll get to in a second. The first type is when you exit a winning, which we mentioned before, but we'll get to in depth in a second, is you get out of a winning trade. The second type is when you get out of a losing trade. So when you have a winning trade, it depends on the stock's performance and your level of conviction. Now, I can't really quantify this in terms of 1 + 1 = 2, but I can't emphasize this enough. It is so important for you to understand how the stock is performing and then align yourself with that performance. If you think I have a very, very high level of conviction because I fell in love when I got married to the stock and the stock's performing awfully, then you're out to lunch. You're out of sync. And the market doesn't care if you're angry, you're upset, you're happy. All that matters is what's happening in actuality, not in your reality in your head, but the actuality component of how stock is performing. If you have a very high level of conviction, again, all this is for the trader's mindset, not the investor. But from a trading standpoint, your goal is to lock profits. So you can do that several ways. If you have a very, very high level of conviction, you can be a little bit looser and say, okay, I'm going to have a trailing stop, and you pick the percentage, again, below an important area on the chart, so you're not just prematurely getting out. If it negates the breakout, now if it doesn't even break out and you get in, and then all of a sudden it does that classic breakout and everybody else is jumping in at that point, which we spoke about in Apple, and then all of a sudden that second area is negated, but you have a cushion, you can get out at that point because at that point something changed and you're locking in a winner. Or if an upward trend line breaks, which we'll discuss in a second. Now, when you get out of a losing trade, you get out of a losing trade if the entry is negated. If you're really aggressive and you don't have a low conviction in the idea and you're just putting the idea on because you see the pattern or you see something, there's a reason why you're doing it, and it doesn't really go in your favor, if you get in early, as we discussed, you're buying support, you're stepping up and buying when most people are not, then you have a very clear logical area to exit with very, very small risk. Now, that's a more aggressive approach. The other way is a single-digit decline below your entry point. Some people talk about 5%, some people use 10, some people use 7 or 8%. It varies depending on your level of aggressiveness or your performance. When you're performing well, you can be a little bit looser. When you're not performing well, you might want to be a little bit tighter. Do more of what's working, less of what's not. But typically, from my standpoint, my comfort zone is 3 to 6%. I don't like to risk more than 6%. 7 if it's a really high quality idea, but again, most of the time when I'm wrong, I want to get out and get out fast, and that's 3% or 4%, and I can easily recover from that, no problem. When you start risking 10%, you need 11% to get back to even. You risk 25%, you need 33% to get back to even. If you're down 50%, you need the stock to go up 100% just to get back to even. So the numbers just don't work, the larger the decline is. So the lower the loss, the better, especially if you have that advanced entry. You don't need to have a big decline because the stock will tell you either you're right or you're wrong. And remember, the goal here is to make money, not to be right or wrong. And that's really important too. So a few facts here that might help you understand the logic better. You trade on what you see happening, not what you think will happen. That's really, really important. We tell everybody that. Most breakouts fail. If you understand that you're driving in rush hour traffic and you're going to sit in traffic, you're no longer going to be angry when you're in traffic. I mean, you might be, but it doesn't make any sense. Really, you're going to be indifferent, or when you get really good, you almost be happy because that stock doesn't work, you're out of it, and now you free up your capital to put into an idea that is going to work. So when you understand that the basic component to buying breakouts, most of them fail, that anger, frustration, all that ill will inside of you is going to just subside and go away through time because you understand it's just the nature of the business. If you leave to go to work during rush hour traffic, you can't be upset when you're sitting in traffic. It's either you leave earlier or leave after. But if you're leaving during traffic, you're going to have to expect it. So adjusting your expectation to understand that most breakouts fail is extremely important. Breakouts come in all different shapes and sizes and different time frames. Be fluid in your approach. Strongly, strongly recommended. Familiarize yourself with the stock and the market that you're trading. Each stock behaves differently. And if you study how that stock performed over the last 6, 12, 18 months, if not longer, it'll give you a good tell on how it's going to perform going forward. Now, the classic breakouts, we covered most of this. You buy the breakout, you have a close stop if it fails, and if it works, great. You just keep tightening your stop as it goes up. The problem is that it's very difficult, and also that it's a wider entry, so you have a hard time quantifying your exit. You short breakdowns, and that's on the other side in stage 4 in a bear market. Always respect risk and limit your downside. Historical precedent, we spoke about that, and the problem again is that most breakouts, from buying classic breakouts, most of them fail, and your risk from entry to your exit is too large to really be effective, and that eats away at your profits. If you lose 8% 10 times in a row, even 5 times in a row, it's very, very difficult to come back from. So let's talk about trend lines, also known as pullback off highs in a stage 2 or pullback off the low in a stage 4. Now, an uptrend is stage 2 and stage 4 is a downtrend. So what is a trend line? A trend line is when you connect several important points on a chart, and that shows you the prevailing trend. It could be a sideways trend line, it could be an upward trend line, a downward trend line, or any variation thereof. The idea is typically the longer the trend lines, the more powerful they are. And trend lines serve, believe it or not, as support and resistance. If you're in a minute chart, it's very difficult to have really important trend lines. It could work and it's more haphazard, but if you're in a daily, a little stronger, in a weekly, stronger, monthly, stronger, and annual, even stronger. The chart below is an annual upward trend line from that 08 low, or in the March 09 low, all the way up until the 2013 breakout. And that's a very clear upward trend line. And if you notice, every pullback stopped exactly on that trend line, more or less. And that stepping back is very, very powerful. So the longer the trend line, the more powerful it is, and the more touches, the better or the stronger that trend line is as well. So here's a chart of the S&P 500 in March of 2009. Well, it's just important to go back and say, okay, what would I have done in real time? How do I use this atom in real time? Well, here's a downward trend line. You saw the 50-day moving average as a blue line. It undercut the red line, which is a 200-day moving average, which is also known as a death cross. You had a lot of just awful, awful decline. Literally, the low for the S&P is 666. I don't make that up. That's exactly the low. Now, what happened was you saw the S&P rocket higher, break out of that downward trend line. Now, it's a shorter downward trend line. This is only a few months long, but this more or less was that Lehman sell-off, and then you had a little bit the TARP and all that stuff in the end of Q4 of 08, and then this was a sell-off in early Q1 of 2009, and then March of 09, you had big follow-through day, an upward trend line, and a downward trend line was broken, and just an uptrend began. But how did it begun? It began by this downward trend line being broken, and that was it. So this big uptrend that we saw for the last 5 years, more or less. So in other words, this whole upward trend line began right here, and it began by just breaking a nice little downward trend line, and it's that simple. Now, will every downward trend line or every small trend line lead to a massive bull market like this or bear market? No, but the idea is that more often than not, these advanced entry points, especially significant trend lines, tend to not only mark important shifts in the market early, but also help you get in ahead of everybody else with lower exits. So in other words, lower risk. It lowers your risk. So what happened? Stepping back, that circle and that downward trend line right there is what we just saw. And then it shot right up, and this is where we are today, more or less. So here's that big 13-year sideways consolidation trend line. Here are the bigger trend lines. This is when 2000 to 2002 bear market ended, and then here's the 2008 to 2009 bear market ending. And again, these trend lines can be drawn on multiple time frames. The reason why I'm showing this is because this is a monthly chart. We saw it on a daily chart. We saw it on a yearly chart, and it's all relevant. So understanding the multiple time frames is really important. And the more time frames that line up with that trend line, the stronger that trend line tends to be. And does it work in other markets? It's not just in stocks. It also works in oil and gold and other markets across the board. This was March 09 also. Crude oil had just bottomed just above 35 bucks, and it just shot straight up to over 100. And it also, because it broke out of this downward trend line, this little triangle pattern. So how do you use this in real time? Well, there's a few strategies for buying the trend line breakouts on the upside or downside. First of all, you get in when a downward trend line's broken, or you short when an upward trend line's breached. Either way. You respect risk, always have an exit point before you get in. Familiarize yourself with the market and stocks and see how do they respect the trend line. Some stocks do, some stocks don't. Most of them do. On average, again, the longer the trend line, the better. So that's a trend line conversation. How do we take those trend lines and apply them to patterns? So this is 7 basic patterns that I like to look for. There are more patterns out there and a lot more complex. The same rules apply with the time frame. These patterns work on the daily, all the way, smaller time frames and longer term time frames as well. The more powerful ones, same exact concept, tend to work on multiple time frames, and the longer the pattern, typically the better it is. So there's a few patterns we're going to go through. The first one's a flat base or a rectangle base. What's a flat base? Well, basically you have that support, here's support, here's resistance, zigzags in between, eventually breaks out, pulls back, finds support, resistance becomes support or finds support at the prior chart highs, and then blasts off again. It's a very healthy breakout from the stage 1 to a stage 2. Okay, great. So the exact opposite in the 4 on the way down. The double bottom. What's a double bottom or a double top? More or less, it's a W for a double bottom and an M-shaped pattern on double top. The classic entry point is the middle of the W or the middle of the M. The next slide here will show you. Here's a chart of Twitter. If you look at Twitter right now, this was as of yesterday's close. It's a little bit of a early entry point. It's forming a double bottom pattern. We sent this out to our institutional clients and even fine leading stocks as well without the chart. But more or less, what happened? You had a big IPO breakout, beautiful looking chart. You had a massive rally. The month of December, stock just soared. Reminds us exactly of Google from when their IPO base 10 years ago, and other prior IPO bases as well. And then what happened? You had a 25% correction from the high right up here, which was 74, 73, all the way down to the mid-50s just a few weeks ago. Now, or a week and a half ago. What happens is it's in the process of forming a double bottom pattern. Here's a classic entry point. Here's my entry point. That trend line comes into place. Okay, it's multiple times here, here, and then more or less right here. You could buy here the 10 days, the yellow moving average, and then 21 days, some other moving averages, which we can include as well. You could buy if it breaks above there. You could buy if it breaks a trend line. The idea is to get in ahead of here. Look at that pocket the stock has to run. Classic entry point, you're buying it up here. What's going to happen from here to all the way up here? It could easily pull back. And what happens more times than not, and I've seen this so many times, it gets up here, pulls back, is perfectly fine, shakes everybody out who bought it up here. They're frustrated, and then it just takes off and soars. So that should help illustrate how to use these advanced signals in real time. And by the way, the chart today, it took off again. Twitter, I think it was up another 5% today, or 6%, almost 6% today. So triangles, another pattern. There's several different triangles. You have on the left-hand side the triangles that are in uptrends, and then the right-hand side are bearish triangles or in downtrends. More or less, it's the same concept. Here's resistance, and there's support. Again, this is a trend line. All these are just trend lines. They're connected, so they look like triangles. The triangle pattern is an advanced entry point because typically you're getting in. If you're defending support, you can get out resistance, or you can hold it by the breakout. But the idea is that on an upward trend, you're going to get in here, you can get in here, or somewhere close to here, not the exactly there. But if you have multiple touches, you can buy that trend line. There's nothing wrong with that. And the idea is it's going to take off and go. And a head and shoulders pattern. What happens here? the left side's a head and shoulders top, which is a bearish pattern. The right side is a head and shoulders bottom, or an inverse head and shoulders, and that's bullish. Typically, these mark a change in trend. That's how do you define, or how do you see a top or bottom? Typically, not always, this is what happens. And now this neckline, sometimes it's horizontal, sometimes it's diagonal. It varies depending on the market and the stock, but more or less, that's the concept. One of the messages we want to drive home tonight is it's important for you to understand the overall concept. What is it that's actually happening? And then how you apply it varies depending on the different situation. Other chart patterns that we like to look for are flags and pennants. Flags are left side's bullish, by the way, and the right side are bearish. But more or less, you want to see a flag can be sideways, or you can be a rectangle, however you want to work. It could be a triangle flag. The idea is that you had a big move, it's consolidating up here, and then it's going to blast off again. The reason why I use this annotation is because you get in a little bit early. The classic buy point is the high of the flag, which is up here, which means you get in somewhere in this area. And it's a little bit too much as far as I'm concerned. So how do you use trendline breaks in real time? Here's a chart of Yahoo based on, I think just yesterday. And let's take a look here and see what happens. Well, first of all these blue circles, early entry points, you're buying weakness. Now, I'm not going to buy every single one of these circles, but the underlying notion is the 50-day moving average, which is the white line, is going to be support. And lo and behold, almost perfectly, except for this little area here, again, that's why it's an art, not a science, it's support. So it's support here, it doesn't even touch it here, support here, breaks it here briefly, but a few days later, it's right back above it, supports it here, supports it here. And as you can see, the classic breakouts are these boxes. Now, if you buy the box, almost every time the breakout's negated. Now, you had this breakout here, or above the dotted line, and then it pulls back, more or less finds support, and then takes off again. Good, so that wasn't really negated. You might have been able to hold on to it. Takes off again. The next box pulls back. It did negate this breakout. And this one, it almost immediately negated it. This one negated it. This breakout negated the very next day or 2 days later. And then it blasted off. You might have been able to get back in, but again, the classic breakout, it's just too far. And then yet again, look at how far extended these classic breakouts are from the 50-day moving average or any other area of support. So you can get in at the classic breakouts, and some of the breakouts work. Like this breakout worked out perfectly. Some of these guys back here worked. But more or less, the problem that most people have is that they're buying these classic breakouts. The breakouts are negated. They lose money. They're upset. And then it's a never-ending process. So some more ideas on the early entry points. Here are the flat bases, the same exact chart of Yahoo, annotated. So we saw the rectangle bases above. How do we use that in real time, right? Well, there's so many bases, but we're low on time. And this webinar will be available on demand if you want to go back and slow things down a little bit and listen and pause. But to get all the questions in, we'll continue moving forward. Here are the rectangle bases or the flat bases. They're not perfect. As you can see, some of them are not base on bases, which is the reason why this is art, not a science. And you can see, if you get in when the trend lines are broken, you have a much better entry point. If you don't want to buy exactly off the 50 or off of the support, you can get in when those trend lines break, and it's a happy medium. It's not support like we saw in Apple, but you're buying close enough towards support where you're not chasing it. In other words, if you look at the far right triangle, the rectangle here, here's support once, here's support again, here's support a third time. And forget the 50-day moving average for a second. Just look at the bottom of this rectangle. The classic entry, somewhere right there, corresponds with the 50-day moving average. You kind of have an upward trend line. It has support right there. It's a no-brainer. If you don't want to get in right there at that exact low, that's fine. You can get in when that downward trend line's broken. The classic entry point is up here, which is still fine. In this case, it worked. But what a better entry point, especially for understanding that most breakouts fail. The exit point is so much lower. Your risk is so much reduced when you get in early. And that's a perfect illustration of what I look for. So to summarize, because we are out of time for the section, we'll move into Q&A in a moment. The advanced entry and exit signals, there are more of them. This was just a beginning introduction to them. You can use moving averages and crossovers, and there's a whole plethora more of advanced entry points, but this was just a brief intro to what it is I look for when I go out there and buy. There's a trader entry, which is you're getting in, the shorter term, whether it's 6 months, 6 minutes, whatever it is, you define it. The investor entry is a little bit longer term. The advanced entry for that it's a little bit, it varies, because the entry from an investing standpoint is that you're going to buy the stock and really not ever sell it, or sell it 10 years down the road. So it's not really it's not really as prevalent an issue for the advanced entry. You're buying it, if you're investing in the stock, or with that definition, so to speak, you're buying it with a 5-10 year horizon, and it doesn't really matter if the stock goes down 50% on you, because that's not, you're not playing that game. You're in it because you're buying the business. The idea, the concept that I want to drive home, it's that enter and exit before everybody else. The crowd is usually wrong. Why is the crowd wrong? Common knowledge, just conventional wisdom. Most of the time, it's wrong. And in this case, you see it time and time again, and you don't need me to tell you this. You know from your own results, buying those classic breakouts typically don't work, and it's very frustrating. So what I did was, instead of keep doing and expecting different results, Einstein's definition of insanity, I just stopped and said, okay, early in my career, I said, this is not working. I got to figure this out for myself. And then I just went back and to the drawing board and just reinvented everything to figure out what actually works for me. You want to reduce your risk with these early entry points and the exit points as well. It's easier to exit when you get in early, because you have an area of support where if that early entry point's negated, that's technical damage. Now, if you buy a classic breakout and that breakout's negated, like you just saw on Yahoo, it could still keep going up and you'll be perfectly fine. There's not major technical damage that's occurred. But typically, if you're able to get in early, I don't mean early by cheating, I mean early based on a logical area on the chart, you're able to reduce your risk significantly, but also you're able to get in at an area where large institutions are defending the stock. You're somewhat aligning yourself with them because you're defending the stock as well with your buying in an uptrend. And more importantly, if that entry point doesn't work, it's negated, you're out. And that's really the beauty behind this whole concept, is that you're going to see some major technical damage, and that's a clear signal that you're on the wrong side of the trade. And the other concept, which has really worked out well for us over the years, has been you want to step up and buy leading stocks on weakness, not just strength.
Thank you all for watching, and we hope that you enjoyed this video. If you were watching us on YouTube, please take a moment and click the like button here at the bottom, and also take a moment to subscribe to us here on YouTube. If you'd like to try out Adam Sarhan's Find Leading Stock service and see all of these advanced entry and exit points in action, visit findleadingstocks.com and save 10% off of any membership level by using discount code CYT when you check out. Again, visit findleadingstocks.com and use discount code CYT to claim your 10% discount. Thank you and have a great day.